Hello and welcome to Coaltrans Connect, which is a weekly webinar series sharing detailed analysis about the changing coal market. My name is Julia Harty, and I'm sure a fair few of you will have met me at various Coaltrans events over the last 2 years. I'm the conference producer for most of the Coaltrans events, and in my role, I do the research, put together the agenda, and work with our wonderful speakers. Next slide. I'd like to introduce our speakers for today. Jimmy Deng received a bachelor's degree in arts from Nankai University in 2009 and a master's degree in business management from the National University of Singapore in 2019. He has almost 10 years experience in both the Chinese and Indonesian coal markets. He's the Vice General Manager of China Coal Solutions Singapore. Sarah Liu has nearly 30 years experience in industrial research and market analysis focusing on coal and energy sectors. She became Vice President for Fenway Energy in 2016. Prior to that, she worked for global mining companies for more than 10 years as a director or senior analyst on coal and energy markets for Peabody Energy, Trek Resources, and BHP Billiton. She also worked for the Chinese government departments, SASAC, SETC, for more than 10 years. She graduated from the China University of Mining and Technology and got a bachelor's degree in management of coal mine enterprise and a master's degree in economics. While we wait for a few more people to turn up, we're going to do a couple of polls just to get a feel for how COVID-19 is impacting your businesses and what your thoughts are on the market. Next slide. The first poll that we're going to do we'll be looking at how COVID-19 is directly impacting your business. So today's session is focusing on China. So I'd like to ask you, what percentage of your business is directly within the Chinese coal market? So we have quite a few votes coming in already. So please tell me, what percentage of your business is directly within the Chinese coal market? Okay, roughly half of you have voted. Okay, so that's a good mixture. So interesting for us to see that you all have different amounts of business within China. The next poll that we're going to do is looking at the Chinese coal market. So we would like to ask you, how long do you think it will take for Chinese coal prices to recover to pre-COVID-19 levels? The options are 0 to 3 months, 3 to 6 months, 6 to 12 months, or more than 12 months. So we'll just wait for a few more votes to come in. So it's at 50% now. We'll just wait for that to go a bit higher. Okay, great. Okay, very interesting to see that most of you think it will take 3 to 6 or 6 to 12 months for the Chinese coal prices to recover to pre-COVID-19 levels. We're going to do one more poll before we get started on the webinar. So just so that Sarah, Jimmy, and I can get an idea of who is in the audience, we would like to ask you, which of the below best describes your job function? So are you a coal end user buyer, a coal producer, trader or broker? Are you working in research or an analyst or a consultant, coal transport, or finance, legal and insurance? So we'll just wait for a few more votes to come in. So please let us know which of the below best describes your job function. Great. Okay, so as you can see, roughly 30% of the audience work within research or are analysts or consultants. Just over a quarter are traders and brokers. And after that, the biggest areas are coal producers, coal transport, and then coal end users. Okay, so thank you very much for taking part in those polls. Hello to those of you who have just joined us, and welcome to Coaltrans Connect. Next slide. Next slide. Great. Hello to those of you who've just joined us, and welcome to Coaltrans Connect. Coaltrans Connect is a weekly webinar series sharing detailed analysis about the changing global coal market. As you can see, next week's session will be looking at India and how COVID-19 is impacting the Indian coal market. Next slide, please. I'd like to take a moment to thank our sponsors, Eco Carbon and Crew Overseas Coal Trading, who've sponsored today's webinar. Next. Coaltrans are planning to run 3 live events in the autumn. Coaltrans China in Shanghai in mid-October, the World Coal Leaders Network in Madrid in late October, and Coaltrans Asia in Bali in late November. Alongside all of these live conferences, we will be running virtual conferences. The virtual conferences will be online and they will allow you to watch seminars, book digital meetings, and attend small group roundtables and much more. As this week's session is all about China, the conference that may be of most interest to you is Coaltrans China. So please do go on the Coaltrans China website where you can find the agenda and all the speakers. Next. This week's Coaltrans Connect webinar is titled China, Recovery and Re-emergence of the Coal Giants. This session will be broken down into 4 parts. The first part will be looking at the economy. The second part will be looking at mining. The third part will be looking at thermal coal. And the final part will be looking at steel and met coal. Before we begin each part, we're going to do a quick poll so that we can see how your views vary with our speakers. Next. So we're now going to do a quick poll before we get started on part 1, which is looking at the economy. So I'd like you to tell us, by how much will China's GDP grow in 2020? The options are -1%, so that's a decline of 1%, 0, so stay flat, 1%, 2%, 3%, 4%, or 5%. The question again is, by how much do you think China's GDP will grow in 2020? Okay, roughly half of you have voted, so we'll just wait for a few more votes to come in before we move on. Great, so as you can see, 35% of you believe that China's GDP will grow 2% in 2020. 21% of you think it will grow by 1%. 18% of you think it will grow by 3%. And then the rest is roughly split. So with that, I'm now going to pass over to Sarah. So next slide, please. Oh, sorry. So now I'm passing over to Jimmy. So Jimmy is about to start part 1, which is looking at the economic impact of COVID-19 on the Chinese coal market. Thank you very much.
Okay, thanks, Julia, for having me here. And Madam Sarah, it's also an honor to have this presentation with you together. Hello, everyone. Hope you are well. I think this COVID-19 impacted the way of our life, the way of our working. I think today I would like to share some information and my thoughts on the economic impact of this COVID-19 in China. So basically, and also the impact on the thermal coal demand. So basically, next. So basically, my presentation will consist of the 2 sessions. The first one is the economic impact on the to China, and also in Q1, and also the impact to the thermal coal demand. So basically, I will following the following indicators. So like for the economy impact is like GDP, investment, export, and consumption, and also the stimulus measures from the government, and also the rate of resuming work of the enterprises. And for the coal demand, basically I will follow in the following parts, and the demand and consumption, and also the price, and also the freight. So next. So let's look at the economic impact of COVID-19 in China. So look at the upper chart. So this is the quarterly growth rate of GDP growth rate in China. So as you can see, the GDP growth in Q1 shrank 6.8%, which was the historical low since the government published the GDP data in 1992. And also this one, look at the lower part is the the GDP growth rate of the three industries. The first one is the primary industry, the second industry, and the service sector. Let's look at the blue part, which is the secondary industry. So actually it shrank like 9.6%. As we know, the secondary industry consists the construction and infrastructure and manufacturing. So this one will directly impact the demand of energy. As everybody knows, the coal is the main source of energy. This will also directly impact the demand of the coal. Next, so the coal demand, later I will cover that one. So this other indicators I'm tracing is the first one is the fixed assets investment by month. As you can see from this one, the fixed assets of the all industries, which is reflected by the blue line, is shrink at 24.5% in February and 6.1% in March. But let's look at the red line. The red line stands for the fixed asset investment in the secondary industry. As you can see, this is ranked much more, which is 28% in February and shrank 22% in March. So this reflects the confidence of the investors for the economy in February and March, and also for the import and export. So totally, the export shrank 70% in February and 7% in March. This is mainly because of the lockdown in February because of the outbreak of this virus in China. But luckily, it's going to recover in March, even still lower, far lower than previous year. But let's look at the import, which is the blue line, the bright blue line. Actually, in February, the import only shrank 4%, and March only 1%. So with this one is like even though China was locked down in February, but the import still kind of stable and not so badly influenced. And let's look at the bottom left. This is the consumption growth rate. This is not about the consumption of coal. This is the society, the total consumption of the society also shrank a lot. 21% shrank in February, and March it shrank 19%. And also the bottom right chart, which is the PMI index, the Purchasing Manager Index, which shows the confidence of the market. So in February, actually, it's only 35.7%. So everybody knows if this number below 50, which means the market is like it's in a downtrend. But luckily, because of the China reopen after the lockdown. So in March, the confidence is going back, which the index jumped to 52. So next slide. So this one is the timeline of the media reports on the rate of enterprise resumed at work. I'm not going to cover each details, but you can see the 2 weeks after the reopening from lockdown. So most of the big companies and large enterprises back to work, but at that time, for the middle and small sized enterprise, only 30% back to work. But and in the end, and in last week, like in April, it's like 84% of the middle and small size companies back to work, resume to work, and 99.4% of the state-owned companies already back to normal. So it's like from this chart, it's like generally speaking, most of the companies, the enterprises, the factories back to work in April. But something I have to add is like many of the companies, the employees came back to work, but the problem is they have no work to do because of the outbreak of the virus outside of China. Because the foreign trade companies, there's no order from the overseas. So even though they can go back to work, but they have no work to do actually. This is why the consumption of the energy is also very low. So next. So those are the economic stimulus measures from the government. So many like fiscal stimulus and monetary stimulus. I'm not going to read all the details. You can read later. Something I want to highlight is the measures related to coal. From March to June, actually the government will cancel the port construction fee for in the coastal ports, which is 6.3 RMB per ton. 6.3 RMB equivalent of 90 cents dollar is until June, and also for the highway toll free for the truck transportation will also be canceled, but this one will until this will end in May. So these are the two main measures from the government to stimulate the economy, but this will end in June and May respectively. Next. So the summary of this session is the China's GDP is shrank a lot, 6.8% in Q1, and the secondary industry shrank more, and also the investment, import, and consumption also shrank a lot. But luckily, in March, it's gradually recovered, and also the government is very determined to continuously stimulate the economy. So we still have a very strong confidence for the economy will go back, and also from other agencies is estimate they predict the GDP growth rate in 2020 of China should be like around 3%, but that's just a prediction. I don't have the exact data, and also the economy is definitely is recovering in China itself because of the control of this virus. But China can never be fully recovered before the world economy fully recovered. That's my session. Thanks for this one. Next.
Thank you very much for that, Jimmy. Before we begin part two, we're going to do a quick poll. So part two is looking at Chinese mining and coal production. So the question we'd like to ask you is, by how much will Chinese coal production change over the next 6 months? Will it increase significantly, increase slightly, stay flat, decrease slightly, or decrease significantly? So please tell us, by how much will Chinese coal production change over the next 6 months? Okay, roughly half of you have voted, so we'll just wait for a few more votes to come in. Great. Okay, so as you can see, the most popular answer is that people think that Chinese coal production will increase slightly at 1%. And roughly a third of you think that. Then roughly a quarter of you think it will either stay flat or decrease slightly. And with that, I'm now going to hand over to Sarah, who will begin part two, looking at Chinese production.
Thank you, Julia, and thank you, Jimmy, for speaking together for today's webinar. Hi, everyone. I'm Sarah Liu from Fenway Energy. I'm going to talk about the coal mining and also the challenges in Chinese coal production. China's coal mines reception was impacted by COVID-19 after Chinese New Year holiday. Due to the travel restriction, mine workers were unable to go back to work, and the road coal transportation is limited as well. In order to ensure the coal supply, the National Energy Administration established a daily coordination mechanism in early February, requiring all coal-producing areas to resume production soon, and issued green passes for coal trucking with expressway toll fee free. And then the average operating rate of coal mines rebounded rapidly. According to the sample mines data of Fenway weekly survey, the operating rate of thermal coal mines lifted from 80% in February, with a minimum of 66%, up to more than 90% in March, and continued up to 95% in April. The operating rate of coking coal sample mines also rose quickly. As a result, the coal output in March recovered rapidly and reversed to increase. March raw coal production reached 337 million tons, gaining a 9.6% growth from a 6.2% drop during January and February, hitting a record high for single March output. Next, please. Now China's coal production has fully recovered. The challenge on coal mining mainly comes from imbalanced distribution of resources or production, safety, environmental protection, and the lagging recovery of the market demand. From the production perspective, the coal production increasingly concentrates to major Western three provinces, Inner Mongolia, Shanxi, and the AA Shanxi province. Xinjiang also has plenty coal resources, but almost thermal coal. Big potential for production growth, but logistics is a big challenge for its coal flowing out to the other regions. Among the top three provinces, Shanxi is the most important and biggest coking coal production region in China. The total coal output proportion of the top three provinces has been rising over the years, from 65% in 2015 up to 70.5% in 2019. The coal logistics cost in China is high due to a far distance from production regions to consumption regions. Next, please. Safety production remains a challenge. The safety performance has been improving over the years with spending more money on safety and upgrading mining technology. Up to now, the mechanized mining level of coal mines in China has lifted to 98%, far exceeding the goal of 85% by 2020, according to the 13th five-year plan. The mortality rate per million tons of coal production reduced to 0.083 in 2019 from 0.162 in 2015. However, the complex geological condition and underground mining still bring big challenges in coal mining. Major geological disasters including water, fire, gas, and ground pressure. In 2019, totally 170 fatal accidents occurred in coal mines, with 316 deaths in China, down 24% and 5% year-on-year respectively, but still challenging. Recently, the government required from April to July to review the mining intensity of the two types coal mines. The capacity of the two types coal mines need to be downward adjusted by 20%, referring to rock burst coal mines with more than 1,000 meters deep and coal and gas outburst mines. According to Fenway Coal Mine Database, the total coal capacity of the two types mines is about 900 million tons per year, of which 400 million tons of coal and gas outburst mine and 500 million tons of rock burst mine. So 20% capacity cut implies 18 million tons capacity reduction, and this has very limited impact because these mines have been rectified for quite a few times in the last few years, and normally they are not able to operate at full capacity. In the last 3 years, China's governments conducted frequent safety inspections, especially when the fatal accidents occurred. This disrupted coal production as local mines had to temporarily stop for rectification. In 2019, the enforcement of safety inspections softened to guarantee coal supply. So we saw the coal production accelerated in the second half year. And the 2019, the total raw coal output grew by 4.6% to 3.85 billion tons, a high growth rate comparing to the previous years. Coal mining in China also causes many environmental issues, mainly including land subsidence, destroy of ecological environment, and the lagging behind of the recovery and reclamation. The other issue is overcapacity production. This is also a key area of the government inspections. Some provinces, such as Inner Mongolia and the AA Shanxi province, use coal sales ticket to control the overcapacity production. Despite many small mines had been closed during the supply side reform, there is still a big number of small mines below 450,000 tons per year, which holds 49% of mine numbers with a capacity share of 8%. These mines mainly locate in Southwest, some in Northeast China, and they are the key focus to be closed in future. Next, please.
Great. Okay, thank you so much for that, Sarah. We are about to begin part 3, which will be looking at thermal coal demand. Before we begin part 3, we're going to do a quick poll to see how your views vary from our speakers. So the question is, what will the Chinese demand for imported coal, and that's met and thermal, be in 2020? The options are in million tons, so it's 300, 290, 280, 270, or 260. The question again is, what will be the Chinese demand for imported coal, met and thermal, in 2020? Okay, so roughly half of you have voted. I'll now share the results with you. So a third of you think it will be as low as 260. And then roughly a quarter think 270 and another quarter think 280. Great, okay. And with that, I'm now going to pass over to Jimmy, who will be discussing Chinese thermal coal demand.
Okay, Julia, next. So hi everyone, me again. So for this session, I'm going to cover something about the decline of the thermal coal demand in China because of this virus. So let's look at the first chart is the industrial consumption of electricity. So in China, mostly the coal is the main source for the electricity. And you can see from this chart in February and March, the consumption of the electricity from industrial side is very low. And especially in February because of the lockdown. And at the same time, if you look at the last chart, which is the new energy, solar energy, nuclear energy, and wind power generation. So you can see the output is very high. Is very high from previous years, and also the hydropower is relatively low in January and February because of the season. But now in March it's going up very rapidly, and also the summer is coming in China, and the output of the hydropower is also will catch up. At the same time, the substitute energy is performing very strong. So this will make the coal power generation face very much pressure. So as you can see, which is reflected by the red line, the coal power generation is in a very low level in January, February, and March. So lower than previous years. So this you can see the pressure on the thermal coal demand. Next, sorry. Okay, so this one is the production of the Chinese coal production. Sarah already covered this. Actually, in January and February, because of the impact of this COVID-19, the production is disrupted. So, and also the output is very low, but it recovered very rapidly in March. So in Q1, actually the total production in China is around 300 million metric tons, which is around like a 9.6% increase from last year. And at the same time, for the import coal, actually from January, February, and March, the monthly import coal are all higher than previous years. So totally in Q1, the total import coal, including the thermal coal and and coking coal, is around 95 million metric tons, which was 28% increase from last year, 2019. So we just do the poll, right?
So actually, the total import volume for this year, we get some like a prediction from the government. The government requirement is like should be within 270 million metric tons in this year, including the thermal coal and coking coal. But if we do a simple calculations like, so if the government want to maintain this target 270 million, then already imported 95 million metric tons. So in the coming 9 months, we only have like 18 million left. So divided by 9, so only like less than 20 million metric tons per month. I don't think this target would be easily to maintain. So personally, I think this year the import coal volume will definitely higher than 270. So that's why the government has this target to lower down the import, but the actual demand is very high. So we predict that the policy on the curve of the import coal will be tightened in the coming months. And the bottom one is the daily burn of the key power plants in the coastal area. As you can see, the red line stands for the daily burn of this year, and the green line stands for the days covered of the stock. As you can see, this one in this year, the daily burn basically in February is far lower than last year. Basically, in Chinese New Year, the daily burn will go to its lowest. Will go very low because of the factory closed down for the Chinese New Year. But basically, after this, it will recover very rapidly, like the red dots stands for in last year. So it should, in normal time, it's going up very fast. But this year, because of the impact of this virus, the daily burn is very low because of the lockdown. Many factories, they cannot go back to work. That's why the consumption of the coal is very low, and also the inventory of the main power plants is very high. As you can see from the green lines, the number of days covered is still far higher than last year. Next. So this one is the import coal, the thermal coal import from the origins. So basically, Indonesia is the biggest exporter of thermal coal to China. As you can see from 2015, year by year, the import volume is going higher and higher. But for Australian coal, it's almost stable, not much change. I think the main reason why China import a lot of coal from Indonesia is because most of the Indonesian coal is low grade, which China does not produce. That's why, and also the cost of this coal is very low, and then the transportation cost, and also very low sulfur, low ash, which is very suitable for the Chinese coastal power plants. That's why China, even the government want to lower down the burn of the import coal, but in reality, the demand, the actual import is going up year by year. But for Australian coal, mostly Australian thermal coal is NER55. This will directly compete with the domestic production, and also add in the long transportation and the currency risk. So the demand for Australian coal is not so high compared to Indonesia, and also the demand for Russia is going up a little bit, but still in a very small part. So the right one is stands for the thermal coal and the coking coal import monthly by China. Something interesting I want to share. When you look at the monthly import of December in 18 and December of 19, it's very interesting. You see the chart is the sharp dive, and then in next month, which is January next year, it's going up very fast. So this is the magic of the government, because actually in reality, a lot of vessels still already arrive in the discharge port, but they are not allowed to do the custom clearance. So from the data, you can see the data, the import volume in January is going up very, very fast. So this is the thing. This is the thing how the government's attitude on the import coal, and also this one is I'm going to talking about the freight. Actually, The bottom left one is stand for the freight from Qinhuangdao, the north part of China, to east part of China and south part of China. So you can see the freight is going down very fast because of the low demand and also the oil price going down this year very, very sharply. That's why the freight going down. And also the right side is the freights of Indonesian ports to China. The green line stands for the double nail port to Guangzhou area, which is the Supramax. And the blue line stands for the Panamax from Samarinda, East Kalimantan to Guangzhou area. So basically, the freight also is the downtrend because of the low demand and also the lower oil cost. So something interesting I want to share is like you see the trend in this year, just like in 2 years ago. So the freight of the Supramax and Panamax are almost the same. So why? Basically everybody knows it's like Panamax freight should be lower, should be cheaper than the Supramax because the quantity is bigger, right? But this time is very different. Never happened before, I think. So the freight of the Panamax is same or even higher than the Supramax. So this is because in 2 weeks ago, in Guangzhou area, so the Guangzhou custom does not allow the custom clearance for import coal. But for Guangzhou port, most of the vessels is Panamax. So this make a lot of Panamax vessel congestion. So congestion in the Guangzhou port. So, and also at the same time, the lockdown of India. So basically India use a lot of Supramax because of the lockdown of India. So a lot of Supramax go to market. So make the markets like for the Supramax vessel, so oversupply. That's why the freight also going down a lot. So next. So this one I'm covering about the price. So looking at the price is very, very bad situation. It's like the CCI, which is published by Fenway, Madam Cyrus company. So you can see since in second half of March, it's like a free fall. The price is falling down very fast, and now it's for the NR55 in FOB Qinhuangdao is on like 470 or 480, which is already in the red range, the red price range. So it's like like last week, the main producers, it's like you unified together, want to hold this price, cannot lower down, but still depends on the market because the market is still oversupplied. And the right side is the price for the import coal, the NR55, CFR, and the NR47 and NR38. So the price are all going down. So the last one is last chart is about the price gap between the domestic coal price and the import coal price. So the blue line stands for the Qinhuangdao FOB Qinhuangdao price for NR55. The red line stands for the CFR price NR55 convert to RMB China yuan. Already adding the 13% VAT. So as you can see, most of the time, the import coal is much cheaper than domestic coal price. Oh, by the way, I want to add one more thing is I just simply calculate the FOB Qinhuangdao with the CFR Guangzhou. Basically, if we do a real calculation, we should like add the freight from Qinhuangdao to Guangzhou, right? But in reality, you want to sell the import coal to the power plants, the end users. Your price must be very competitive. Otherwise, they will not consider to buy the import coal. So no bother to think about the freight from north part of China to south part of China. So as you can see, like 2 weeks ago, the gap is become very low. So the Chinese buyers has lost their interest in the import coal, especially the Australian coal. That's why the price of Australian coal dropped a lot. Then the gap became bigger. Then more buying interest come in. So this is the the challenges for the import coal. So the huge pressure, and also the domestic price also under huge pressure. This is really bad market situation. Next. So the summary is like, so the domestic coal production was interrupted in early February, but recovered rapidly in March, and the import coal rose 28% year-on-year in Q1 this year, and the curve on the import coal policy might be tightened again. Definitely, no doubt about that. And also the coal demand in February was interrupted by the lockdown because of the COVID-19, and also the clean energy output is higher, is outperformed the previous years. It's another pressure to the coal consumption, and also coal price rose earlier in February because of the disruption of the production, but kept falling in after second half of February, and the price now is even lower than the price in, I think is even worse than 2015 and 2016, and also the freight declined due to the low demand and oil price falling. Next. So this is a little advertisement, just a brief introduction on CCS and REX. And we have a 20 years experience in coal supply chain management, both domestic China and in 2010, we started our import coal business, and we are public listed in Shanghai in 2012. And now we've become the biggest importer from China. And now we are expanding to international market. Basically, we use CCS Singapore as a buyer in Indonesia. And also we use REX commodities for non-China market. That's my sharing today. Thank you for your attention. Next.
Great, thank you very much for that, Jimmy. Next slide. So we're now about to start the fourth and final part of the presentation. So I would like to ask you, how do you think the level of steel production will change over 2020? Do you think it will increase significantly, roughly 3%, increase slightly, 1%, stay flat, 0%, decrease slightly, so -1%, or decrease significantly, -3%? So just to repeat that question, that is, how will the level of steel production change over 2020? Okay, let's see the results. So it seems like it's fairly roughly split. 28% think that it will increase slightly, and then 25% decrease slightly, and 26% decrease significantly. So with that, I will hand over to you, Sarah, for part 4, looking at the steel and met coal markets. Next slide.
Okay, thank you, Julia. Now we have a look on steel and met coal markets. Among the 4 major coal-consuming industries, the iron and steel is the only one to maintain positive growth in the first quarter. The crude steel output grew by 1.2% year-on-year, and the pig iron grew by 2.4% year-on-year. The steel production remained strong, but affected by the COVID-19, the downstream manufacturing and constructions resumed slowly, so the demand for steel was sluggish, resulting in the steel stock accumulating. So the steel stock in major cities hit a record high to 26 million tons in mid-March. In response, some steel mills did maintenance, and the average daily output of key steel mills decreased in March. The crude steel production decreased by 1.7% year-on-year in March. And from late March, the steel stock started the stocking cycle and dropped slowly. Next one, please. Comparing to steel supply side, the demand side gets more heat. Although the growth of the property and the infrastructure investment rebounded in March, but still declined by 7.7% and nearly 20% year-on-year, respectively, in the first quarter. And the production of automobile remained far below the last year level. And the production of electrical home appliances recovered strongly in March from extremely low level in January and February, but sales remained very big. So the steel demand remain quite constrained. It is gradually resuming, but have not yet back to the last year's level. Next, please. The coke production. In the first quarter, the coke output fell by 4% year-on-year. The operating rate of all scales coke plants decreased significantly in February, but March operating rate recovered strongly. And the coke production recovered quickly as well, nearly back to the level of the last year. So regarding to the survey data samples, the operating rate of Fenway sample coking plant dropped to 79% in February and rose rapidly in March, reaching 88%. And now they are operating at high level. Next, please. So the prices. This slide shows the coal prices and the downstream product prices trend. So the first look at the thermal coal price. Thermal coal price rose in February but fell from March due to the market shifted to oversupply as a result of a strong supply but weak demand. In April, the operating rate of coal mines continues rising, while the downstream industries are resuming gradually but still have not returned to normal. Especially the service industry is still greatly affected. Entertainment activities have not resumed. Cinemas, theaters, KTV, museums are not reopened. Restaurants reopened, but with not good business due to less customers. As well, the strong coal imports in the first quarter weighed on domestic market as well. Furthermore, the northern areas ended heating season. The power demand has stepped into the weakest season of the year, and the power plants entered destocking state. So the oversupply for thermal coal market is intensified in April, leading the price fall to accelerate. CCI 5500 coal fell by all the way from 576 yuan per ton on February 21st, down to 472 yuan per ton on April 26th, a drop of 18%, or 104 yuan per ton, equivalent to $15 per ton. The thermal coal prices have already fallen back to the level of August 2016, which is just the starting point of this cycle of price rise, driven by the supply side reform. Looking at coking coal, similar to thermal coal, the price of coking coal rose slightly after the Spring Festival due to poor supply. But from mid-March till now, the coking coal price continued falling. The main reasons include, first, the coal supply has recovered rapidly. Second, the coal imports increased strongly, squeezing the market for domestic coal. Third, the coke prices have dipped for 5 runs, and the decline is transmitted to the upstream. The price of Shanxi premium hard coking coal at Jintang Port fell to 1,500 on April 26, from 1,610 yuan in February 21st, down roughly 7%, or 110 yuan, equivalent to $15.5 per ton. Regarding to the steel and coke market, the growth of iron and steel production and high steel stock, but lagging behind the steel demand weighed on the steel market. So the steel price is fluctuating in the falling trend. We can see from the bottom left chart. And for the coke price trend, since the coke production resumed from March, the coke supply trended to loose, and the coke prices has experienced the 5 rounds of reduction since February, with a cumulative drop of 250 yuan per ton, equivalent to 35 US dollar per ton. So at present, the coke price is close to the break-even line in China. And for some area, like in the Mongolia, the coke plants, some coke plants are losing money. But in Shanxi, in Hebei, in Shandong, they still have some volume of the thin margins. So along with the coke inventory at the plants reduced to a low level, so the coke plants have asked for twice price rise, but not accepted by the steel mills, and the coke prices remain stable at the moment. Next, please. The coking coal price. The price gap between China market and seaborne market has enlarged to a very high level. China's coking coal price, from the chart we can see clearly, is stronger than seaborne price. Due to the production suspension from global steel mills, the seaborne coking coal demand reduced apparently in the seaborne market, but the seaborne suppliers haven't cut the production accordingly. So the seaborne market turned to a serious oversupply, and the surplus targets, the tonnage of the surplus targeted to Chinese market. But China is tightening the coal imports for 2020, and the imported coals are getting difficult to clear the customs, especially for trading companies. So this constrained the imports from Chinese buyers. Therefore, we saw the seaborne coking coal price plummeted from mid-March. The FOB price for Australia premium low-vol hard coking coal has dropped 27% or 44 US dollar to 120 per ton on April 24th, from 164 in mid-March. So meanwhile, the China CFR price fell to 127 US dollar from 174 US dollar, also down 27% or 47 US dollar, equivalent down by RMB 330 yuan per ton. So for the current seaborne price level, it already went back to the low point in August 2016. And for the same period, domestic Shanxi premium hard coking coal price at Jingtang port fell by RMB 120 yuan. So the price gap of the Chinese and seaborne market for premium hard coking coal at Jingtang port, VAT inclusive, has enlarged to 68 US dollar, equivalent to RMB more than 400 RMB per ton. So very cost effective for seaborne coal now to the Chinese buyers. So with the huge price gap, the import demand will be strong, but the big uncertainty is for the government's import restriction policy. Although the second quarter is a traditional peak season for coking coal demand, but the weakness of steel and coke prices and high stocks, as well as the huge price gap between the domestic and seaborne market, the Chinese coking coal market will continue and pressure, and the price is expected to continue weak. Next, please. China's coal imports. China's coal imports are regulated by the Chinese government with the target of keeping coal imports at a reasonable level, meeting the domestic supply gap. In the last 3 years, the China's coal imports continue increasing despite of under the government control. In the first quarter, China imported coal to 96 million tons, growing 28.4%, remained very strong, and of which thermal coal imports reached 75 million tons, up 29% year on year, and the coking coal at a level of nearly 21 million tons, up 27 year on year. So for 2020, the coal import policy is intensified, and the restrictions started earlier. This implies the intention of the Chinese government to control the coal imports in advance, comparing to the previous years, in order to avoid a sharp fall at the year end and support the domestic coal market. Next, please. Summary. So the COVID-19 global pandemic has brought unprecedented impact on the economy and the social life. More than 60 countries or regions locked down, with people keeping social distancing, travel restriction, and all unnecessary business shut down. The global economic recession is guaranteed. The China's economic data plummeted in February, with all major indicators falling sharply. But March data improved in line with the economic activities resumption. The impact of COVID-19 on coal supply is small, but the impact on the demand side is larger and lasts a long time. After the resumption of the production, the China's coal market shifted to oversupply, with prices declining. The thermal coal demand is weaker, so seeing the sharper price drop than coking coal. The loose supply of China's thermal coal market is hard to reverse in the short term, waiting for demand recovery or production cuts. So the coking coal price in China remains downward pressure due to loose domestic supply. In addition, lower seaborne prices will squeeze the domestic market price. Driven by the remarkable price gap between the Chinese and the seaborne market, so the China's coal import demand remains strong, but the import will continue regulated by the restriction policy, and the restriction starts earlier in 2020, and the coal imports will likely to decrease moderately. Next, please. And last, I would like to give you a brief introduction on Fengwei Energy Services. As you know, Fengwei has a web portal, www.sxco.com, publishing the news, the government policies, the statistical data, and the prices, the coal inventories, and the downstream sectors information. After the 20 years practice, we established many databases focusing on coal and the downstream sectors, including the coal mine resources and capacity database, the cost database, the coal quality database, and also the database of steel mills in China, the coking plants in China, and the power plants of China. So based on the database and the information, we also publish the regular reports on the weekly basis, monthly basis, and annually basis. And we also provide the customized services based on the requirement of clients, figuring out a scope of work after our discussion, focusing on the industry supply demand analysis and forecast, the price forecast, and also the due diligence. We also do the big data based market forecast for coal and coke. So we also do some the coal coking plant operating practice to help them to save the cost by optimizing their coal blending. Next, please.
Great, thank you very much, Sarah. Next.
Yeah, so yeah, that's all my today's presentation. So here is my contact details. So you can contact me if you have any demand via the email, company email or private email, or the mobile phone number. Thank you for your attention.
Thank you very much, Sarah. And also thank you to Jimmy and both of our sponsors. We're now going to begin the Q&A session. So if you'd like, we would love to hear your actual voice. So please do take advantage of the raise your hand button. Anyone who does choose to raise their hand, we will prioritize those questions. Okay, so I can see a question that's come in already from Hugh Lee. Why is there a plan to close the smallest coal mines when they provide local employment? So Sarah or Jimmy, please can one of you answer that question?
So sorry, what's the question for that?
The question is, why is there a plan to close the smallest coal mines when they provide local employment?
Oh, okay. I can answer this question. I think the main reason is to shut down the small coal mines for the safety reason, because the small mines with the scale below like 450,000 tons per year, they have poor performance on the safety. They have not much safety investment, and the geology is a challenge. So it is hard for them to improve the performance on the safety, and the resources are scarce, or their resources will be depleted. So I think the key reason is for the safety. So the Chinese government want to improve the industry concentration to build the large modern coal mines with a high productivity, and to remove the unsafe small mines.
Great, thank you very much, Sarah. We're now going to take a question from someone who's raised their hand. So VK Aurora, I've now accepted you, so you need to unmute your own computer. Okay, so while we just, great. Okay, Mr. Aurora, you're ready to ask your question now.
Right. Sarah, I would like to know that, do you think China has now got an upper hand on the virus, unlike the rest of the world, which is still struggling to come to terms with it?
So Sarah, did you hear that question okay, or would you like it repeated?
I need to repeat it.
Do you think China has managed to get an upper hand on the virus when rest of the world is still struggling to come to terms with it?
Okay, so the question was, do you think that China has managed to get control of the virus while the rest of the world is struggling with it?
Okay. Yeah, I think the government is trying to manage. It's doing their best, I think, to control the virus, to prevent the infected cases rebound, to keep a balance between the economic activities resumption, and also for the prevention of the virus coming back again. So I think it's a tough challenge, or it's a tough task, but we have to get through of this. And currently, I think most of the regions in China, the manufacturing, the industrial sectors, they are resuming production gradually, step by step. I think the challenge for some sectors, or for some producers, are the lack of the orders from the overseas market. So if we look at the data released by the government on the daily basis for the infected cases or suspension cases, we can see China is doing quite a good job, and the cases are under control. I think it is under control, and the risk is from the imported cases from other countries. Chinese people are flying back from overseas countries, and they are tested and get infected, and then they are doing the quarantine. And China is following the suspected contacts with those people. So I think the government and the people still pay a lot of attention on the prevention of the virus. Thank you.
Great, thank you very much, Sarah. I'm now going to invite Adji to speak. So I have unmuted you, so you now need to go onto your computer and unmute yourself.
Hey, hi, Sarah.
Hi.
My questions. Yeah, my question is that what do you think about coronavirus has Indonesian supplier? To almost 60%, our production is dedicated to China.
Okay, so I'm actually going to hand that one to Jimmy. So the question was, how do you think well, please correct me if I'm wrong, but the question was, how do you think the situation will impact Indonesian supply to China? Is that correct, Adji?
Correct.
Yes, that's correct. Great. Okay, so Jimmy, you're based in Indonesia. I believe you're calling from Kalimantan today. So Jimmy, why don't you try and take that question?
I think this will not impact the supply of Indonesian coal to China. I think the main impact is like the price. China is still buying a lot of Indonesian coals. Like I said in the presentation, Indonesia has the low grade which China does not produce. So no matter what, China will still keep buying the Indonesian low grade coal. So as long as the power plant is still running, they still need the Indonesian low grade coal. So I don't think that this will impact the supply of the coal to China. Maybe because of the outbreak of the virus in Indonesia. So now it's like the new cases also increasing every day. So I'm worrying is like if the virus outbreak in the mining area, maybe this will impact the supply of Indonesian coal to China. That's my only concern. Am I answering your question?
Great, that's perfect. Okay, I'm now going to invite Kelvin Kai to speak. So Kelvin, I have unmuted you. So you now need to go onto your computer and unmute yourself. Okay, while we wait to hear from Kelvin, we're just going to take one of the other questions. Oh.
Hello, hear me?
Hi, Kelvin. Hello? Great, we can. Hi. What's your question?
Hi, my question will come to Mr. Jimmy Deng. Hi, Jimmy.
Hi,
I'm Calvin. Yeah, Calvin from Tata, from China. So glad to see you in Indonesian and listen your presentation. It's a wonderful presentation for me. Okay, so one question is now, as you know, the Indonesian cargo, the price already in historic lower.
Yep.
So do you think the price will continue to fall and move to lower price in after 2 months in May or June? I want to hear your voice for this price respects.
Okay, Ajay, thanks for the question. To be honest, for the coming 2 months, it's very hard to say the price will keep falling, but we look at the facts. Actually, for the production cost of the no grade, let's say NAR 38 for Indonesian coal. So roughly the production cost is around $25 to $30 difference, depends on the mining situation. But now it's like market prices are like 24, even below $24. So this price, the current market price, is lower than I think all of the NAR 38 producers. So but another thing is the oversupply situation is still not changed. So but when this market is so oversupply, I don't think the production cost really matters. So now it's like we still, for the Indonesian miners, still need to clear the stock, the inventory first, then cut the production, then gradually change the production, the oversupply situation. Then there'll be some hope the price will rebound. Another thing is the coronavirus, when we can control this worldwide. So still now maybe they already reached the peak, is a downtrend. But when the lockdown of the countries will reopen again, it's very hard to say. It's like Indonesia already extend, Singapore extend, like India also extend. If those countries still locked down, I don't think there's any hope the price will stop or increase in short term in the coming 2 months. Still very hard to say.
Great, thank you very much. Okay, we are now going to ask the next person. Hugh Lee. Hugh, I'm now going to unmute your microphone. So please, can you, yeah, great. Hugh.
Hello, can you hear me?
Yes.
What measures will the Chinese government use this time to limit coal imports? And will they particularly affect imports from Australia in the way that they did in some previous years?
Okay, so Hugh, can you just repeat that question again?
What measures will the Chinese government use to limit coal imports this time? And will they particularly affect imports from Australia like they did in previous years or some previous years?
Great. So how will the Chinese government limit coal imports, and do you think it will particularly impact Australia? So Sarah, are you happy to answer that one?
Yeah, okay. For the Chinese, the policy tool to control the coal imports, there are several ways of doing that. I think the first is the import tariff, but now playing not a big constraint for coal imports now. And the second is the coal quality management methods applying to both domestic coal and imported coal, but mainly imported coal, because it's difficult to check the domestic coal quality to the end users. But for imported coal, because they need to get the coal test at the customs, so China has tightened the quality management requirement, issued a new method in 2015. But this quality management requirement is not very high, regarding mainly focus on the ash level or sulfur level, and also the fluoride trace element, etc. So for major coal exporting countries, the sulfur and ash level is not a constraint, but for some countries, fluoride trace element is a risk. And the third tool is the import quota. The China's customs issues the import quota for individual ports, and to also the individual big end users like the state-owned power companies, power groups, and also the big steel mills. So they manage the total quota of that. And also the last tool is to manage the procedure of the coal, imported coal, the customs clearance. And this is mostly used for controlling the coal imports, especially for the second half or the fourth quarter, the import coal control. Because overall China's import demand is quite strong. So most of the coal import quotas have been used in the first 3 quarters, and then at the year end, the import quota will be very scarce. And then we saw the coal imports drop sharply in November and December. So for this year, it is reported, or it is rumored, that the China's total coal import quota will be back to the level of 2017. Just like Jimmy mentioned during his presentation. So that will be 271 million tons for this year's the import target. But the first quarter, the coal imports was so strong. And also I expect the actual coal imports will be higher than the quarter. So maybe likely reducing by 20 million tons from last year's 300 million tons to 280 million tons. but the tools, I think the government will use similar tools. Yeah, but they are tightening the tools from earlier period comparing to the previous years.
Thank you very much, Sarah. Okay, Jake Bowman, we're now going to unmute you. You will still need to unmute yourself. Great, Jake, you're ready to ask your question.
Hi, Sarah. So Hugh's question touched on what I want to ask, but as you know, domestic prices in China are below the green range of reasonable prices of 500 to 570 yuan per ton. If prices persist at this level or even go further, do you think we're likely to see any intervention measures from the government? And if so, what type of measures?
Great, thank you very much, Jake. So just to repeat that question, if the price falls further below the green range of 500 to 570, will there be any intervention from the government?
Yes, you know, the current domestic thermal coal price now is standing at a low level, back to the 2016 level. For CCI 5500 coal, yesterday is standing at 469, already below 470 yuan per ton, and broken the red line, you know, set by the Chinese government in earlier 2017. So according to the government regulation, if the thermal coal price dropped down to below 470 yuan per ton, the Chinese government will start, you know, intervene the market to make sure, you know, the coal market stable. So recently, it is rumored that the China's government starts regulating the coal market, and there are some news reported that there is a requirement that the FOB coal price indexes will not be below 485, but actually already broke that level already. And the second is 5,500 FOB price for major four producers are not lower than 500 yuan per ton in principle. But actually, after the price discount, this price already, you know, break this line. And the coal, the third news is the coal production in major provinces will be determined by the verified capacity. And so that means the production will be under-regulated by the Chinese government. Then the government will supervise the production for overcapacity production and to make sure, you know, the coal control the coal production. And recently we heard that in Mongolia, the local government is doing the coal resource development rectification, sourcing back for the last 20 years for the tax issue, all the resource development, you know, understandable like that. So this might be some impact on the local coal production. And also, you know, the party conference, annual party conference is set to be held on May 22nd. And before the conference, the coal production normally is under the strict supervision, and the explosive materials will be controlled. So this kind of measures will be introduced by the Chinese government to control the coal production. But and also last week there are some major anthracite producers along with coking coal producers proposing to cut coal production by 10% in May. But this is not a statutory requirement by the government, but it's a proposal. With the current level, so it is a question mark whether the coal producers can follow that proposal. So we will see. I think the price, if the price even lower, I think the coal producers will be pushed to cut production. And now we have heard some news from the major coal producing areas in Shanxi, in Shanxi, and in the Mongolia for local mines, due to their higher coal inventory. So they are pushed to cut production to some extent. So I think if the price continues declining, we will see the production cut finally. And we expect the current price level, already below 470 yuan per ton. There are still some limit space for further drop, but not much, I think. And in May and in June, I think along with the downstream sectors production resumption and getting the temperature higher, the daily burn will be improving as well.
Great. And Jimmy, is there anything you want to add to that?
Oh, yes. I want to add one more comment. I think this time the price drop a lot. It's not only because of the too much production. The main reason is the absence of the demand. I think rather than for NDRC, rather than intervene the price, better they just try to improve the economy, try many measures to stimulate the economy. When the economy is going up, then the demand came back. Then with this will help the price. That's just only one comment I want to add.
Great, thank you very much. Okay, Rajendra Prasad Ritolia, I'm now going to unmute you. You will need to go on your computer and unmute yourself. But once you've done that, we will be able to take your question. While we wait for you, we're just going to answer one from the chat. Oh, Rajendra, are you ready?
Yes, I'm ready. Can you hear me?
Yes, we can hear you.
I just wanted to know, taking everything into consideration what has been said, what is the expected level of production, thermal coal particularly, by the year end or during the year 2020? And what will be the supply demand match or mismatch? And what will have the impact on the price, whether it will continue to remain the low as of now, or whether there is any chance of going it upward or further downward?
Great. Okay, thank you very much. There's essentially 3 questions in there. So the first question was, what is the expected level of thermal coal production at the end of 2020? So Sarah or Jimmy, what do you think will be the expected level of thermal coal production at the end of 2020? Sarah, are you happy to take that?
Yeah, okay, yeah. This is a very good question and actually a difficult question to answer at this moment. We normally do a supply demand analysis and the forecast for the annual coal supply and demand. Based on our current assumption, the thermal coal demand, the coal production for this year will continue increase slightly. Last year, the total coal production was 3.85 billion tons. And this year, we expect the total coal production to increase by 0.6% to 3.87 billion tons. And because China, there is no production split by thermal coal and coking coal, the thermal coal supply is calculated based on the downstream sector's demand. So, in terms of the thermal coal supply, we expect it will have the same growth rate as the total coal, growing by 0.6%. So the total thermal coal supply will reach 3.116 billion tons for this year. And then regarding to the thermal coal demand, we expect the thermal coal demand to decline moderately for 2020. We expect the thermal coal demand dropped by 1.9%. So last year, the thermal coal demand increased by 2.2%. But this year, we expect by 1.9%, because for the first quarter, the thermal coal demand decreased by, I don't remember the specific figure, but it's roughly, by 5 or 6%. So we expect the thermal coal demand will recover in the second and third and fourth quarter, but the average for the whole year will still see a slightly decrease by 1.9% for thermal coal. So as a result, the thermal coal demand. So we will domestically we will see 80 million tons surplus for this year. That means that the thermal coal stock will increase by 80 million tons at the year end. Thank you.
Great. So the second and third parts of his question were, what will be the supply-demand mismatch and how will that impact the price? So Jimmy or Sarah, what do you think will be the end of year supply-demand mismatch and how will that impact prices?
Yeah, I can say first and then Jimmy can add some comments if you want. So I think overall, just now I talked about the thermal coal market supply-demand balance. And for coking coal, we expect the coking coal market for this year will continue lose supply. With the average, the annual coking coal price will continue dropping from the last year's high level. So for the annual coal average prices, we expect to see the coking coal price down to 1,370 yuan per ton from last year, down by roughly 12% from last year. That's because we expect the China's total coal capacity effective coal supply capacity will continue to increase. Last year, we saw the 150 million tons new capacity coming on stream. And this year, we expect another 140 million tons coal capacity coming on stream. So both thermal coal and coking coal capacity will have some new additional capacity coming on stream. So after the 4 years of supply side reform, after the many small mines capacity have been eliminated, but I also mentioned that many big scale modern coal mines under construction, and they will be commissioning over the years to improve their effective capacity. So we expect the China coal industry has entered to a new cycle of capacity expansion. So China's coal supply capacity is increasing, while the overall, the coal demand for 2020 is still impacted by the COVID-19. So the coal demand for this year will decrease, both for thermal coal and coking coal will decrease. So the domestic market will see some supply surplus. So that will push down the coal price for both thermal coal and coking coal to decline.
Great, thank you very much, Sarah. I think we have time just to take one more question. So Wen Husit, I've just unmuted you. Yep, you should be able to speak now.
Oh, thank you. My question is this, is there any policy from the Chinese government to supply cheap electricity for the economic recovery? And if there's one, how will this affect your domestic coal producers? Thank you.
Okay, can you just repeat that question, please?
Oh, sorry. Is there any Chinese government policy related to supply cheap electricity to support economic recovery? If there's one, how will this affect the domestic coal producers? Thank you.
Okay, thank you very much. So the question was, is there any Chinese government policy on electricity to support economic recovery?
GB, would you like to say something first?
The question again was, is there any Chinese government policy on electricity to support economic recovery?
Please, Sarah, to answer these questions. You're more professional.
Maybe it's a tricky question. Sarah, what do you think? Do you have an answer to that?
I'm not quite clear about the meaning of your question. I think you want to ask whether there is a policy for Chinese government to support the power consumption demand, to support the coal demand. Is that right?
Yeah, around probably, yeah, about that. So what I'm trying to say is there any effect for the coal price? Sorry, for coal producer on the electricity price charged to the customers.
Okay, okay.
Mm-hmm.
As far as I know, now the Chinese government is doing more reform on the China's power tariff, like power price, by turning to more marketized market. So previously, the benchmark price for the power price is controlled by the central government or provincial government. But over the years, we have seen the trend that more and more marketized power have been traded between the big power users and power generators. And last year, China issued a new power price mechanism to release the no plan for the benchmark power price, to leave the power benchmark price linked with the market. That means the big power generators and the big power users, they can discuss and negotiate it for their power price. And the market direction is to make sure the power price continues declining to support the power demand, to reduce the power consumers' cost. So that's the overall the government policy direction. That will provide a challenge for the thermal coal or coal-fired generators, because the new price mechanism will push them, to sell power with a lower price. But this policy will benefit for the power consumers. So I think that's the definite direction that the Chinese government want to release more marketized reform on both coal and the power market.
Great, thank you very much, Sarah. Next slide, please. I'd like to take this opportunity to thank both of our speakers. Thank you so much, Sarah, and thank you so much, Jimmy, for all of the hard work that you put into your presentation. I'd like to thank our sponsors, Eco Carbon and Crew Overseas Coal Trading Company, for sponsoring today's session. Thank you to our wonderful audience for joining us today. Please, please, please do take a second to fill in the feedback form. We do go over all of your answers and use them to improve the next webinar. Next slide, please. We're planning to run 3 live events in the autumn. Coaltrans China in mid-October in Shanghai, the World Coal Leaders Network at the end of October in Madrid, and Coaltrans Asia at the end of November in Bali. Because you have joined the webinar today, you may well be interested in Coaltrans China, so please do go onto the website and have a look at the agenda and all the speakers. All of these events will be live, as you're used to attending in person, and they will also have a dedicated virtual conference running at the same time. The virtual conference will be online, and it will allow you to watch seminars, book digital meetings, and attend small group roundtables. Next. Next week's Coaltrans Connect webinar will be about how COVID-19 is impacting the Indian coal market. Please check the Coaltrans Connect website for more information and to register for that. Looking forward to seeing you all there. Thank you so much, Sarah and Jimmy, and to our sponsors. Thank you very much, everyone. Goodbye.
Thank you.
Thank you.
Bye-bye.
Thank you.